We've been receiving a lot of questions from clients and customers and realtors and even other lenders as to what's going on in the market, what's happening to rates, what's causing the rates to go up. And so I want to spend a little bit of time talking about that. So first of all, what we hear about on the news with the Fed raising the target interest rate of the Fed funds rate, that is not actually tied to mortgages. It's a metric that is the borrowing rate for which the government lends money out for a variety of reasons. This is important because the cost of money then, sort of filters through the economy in a variety of ways. And the goal of the Fed raising the funds rate is to reduce consumer spending, increase the cost of borrowing to slow down the economy so that we can get inflation under control. We'll circle back to inflation in a little bit. But I want to talk a little bit about what is actually the metric or the thing that we're looking at with respect to mortgage rates. Mortgage rates are tied to the 10-year Treasury. Okay, so right now the 10-year Treasury moves up and down based on demand. So how many people are interested in buying Treasury bonds? In a normal market, the money would flow out of the stock market into the bond market during a time like this when the stock market's dropping. That would typically generally serve to reduce interest rates. Right now, the Fed is trying to push rates up, and they're doing it not only by raising the cost of borrowing from the federal level, they're also doing what's called quantitative tightening. To understand quantitative tightening, we have to go back in time to the recession that was caused by COVID. And at that point in time, the Fed had dropped the rate to zero, which was designed to help spur the economy, but it wasn't enough. And so the Fed engaged in what was called quantitative easing. And essentially, the Fed started buying Treasury bonds from itself. And by doing so, they increased the demand for Treasury bonds, which drove down the yield on the Treasury bonds, which ended up reducing mortgage rates down to the high twos or low threes. Now we have the opposite thing happening. So not only do we have market uncertainty, we have the Fed raising rates, we also have quantitative tightening. And the reason why I point that out is a lot of us aren't even thinking about that. We're only focused on what the Fed's doing. The quantitative tightening won't last forever. Okay, at some point they're going to sell all the Treasury bonds that they bought during quantitative easing. And when that happens, that should serve to settle rates a little bit, or at least stop the rapid upward movements. We may already be at that point. We won't know for some time, but it's important to understand quantitative tightening. Back to the 10-year Treasury, in a normal market, again, we see the 10-year Treasury tend to rally when the stock market rallies. We tend to see it drop when the stock market goes down. Right now, there's a little bit of disconnectivity with respect to this. They're not moving in tandem like they typically do. So there's a lot of opposing forces. There's a lot of uncertainty in the market, and it's causing a lot of whipsaw back and forth with respect to mortgage rates, 10-year Treasury rates. And until we get some clear guidance from the Fed that the lion's share of the increases have passed or that they're slowing down their pace, we're likely to see some choppy times. Once they slow down the rate of hikes with respect to the Fed funds rate, the next thing that we're looking for is for them to wind down the quantitative tightening or even potentially slow down the pace at which they're selling those bonds. Both of those things would serve to improve the rate environment for us. A couple of other things to note about the current rate environment. While I'm certainly not predicting that rates are going to come down, there is a lot of industry experts that tend to think that's going to be the case. And it's actually evidenced by the secondary market. And what I mean by that is when we look at mortgage rates right now, almost every rate has a significant cost to buy down to. And the reason for that is that the folks in the secondary market that are employed and paid to sort of hedge and make bets on what they think the future holds for us, they believe that the loans that we're originating today are not going to last long enough for them to earn a return on their investment. And so they're not willing to pay a yield to lenders to buy those loans. And so we're having to go to the clients and charge it in the form of discount points. So they're betting that rates are going to come down at some point in the not too distant future. That's the best guess that I have as to what's going to happen, but it's certainly not a guarantee. One thing I would also kind of throw into the mix when it comes to interest rate environment is the quantitative tightening that we talked about is really an artificial force. And so it's causing things that we're not used to seeing, just like it did when they were using quantitative easing. we saw rates drop, I think, to a level that was lower than what they expected. And right now we're seeing rates run to a level that wasn't expected by most industry experts. And you can kind of compare this to where interest rates have been in the past with a similar Fed funds rate. We would have expected to see mortgage rates today, in the low to mid fives. And in fact, we're to the mid sixes now, in some cases even higher, depending on the product. If you found this information helpful, please like, subscribe, and find us on YouTube, and tell some people.